Hi, I'm Wong, Director of Phillip Capital Management Hong Kong. The China stock market extended its dramatic sell-off with the Shanghai Composite Index dropping to a recent low of 3,686 points this Friday. Despite central government efforts to buoy market sentiment, the Shanghai Composite Index has recorded cumulative losses of about 29% since hitting a 7-year peak of 5,178 points on June 12th. The People's Bank of China cut both its benchmark interest rates and bank's reserve requirement ratio last Saturday, which is a rare move. The last time it did so was in October 2008, during the height of the global financial crisis. Subsequently, the China Securities Regulatory Committee, or the CSRC, had made public comments to talk up the market, loosen margin financing rules and lowered stock transaction fees. But all these efforts failed to stop the stock market's slide. The wave of selling was linked to margin financing, which had topped 2 trillion yuan in mid-June, and investors who borrow money from the so-called fund matching companies to speculate in the stock market. In the murky world of great market margin financing through these fund matching companies, leverage can reach 8 times or even higher, and there are no limits on which shares investors can bet on. So as the market continued to slide, the risk of unwinding positions held by investors who borrowed money from these fund matching companies become more imminent. With further deleveraging, the Shanghai Composite Index may test the support level around 3,400, and in the meantime, we continue to recommend caution in trading. Our research department has issued a report on Kangmei Pharmaceutical. The stock code is 600518. We give it a buy rating and target price is 62.44 yuan. The company issued bonus shares on 15th June on a 10-for-10 basis. Therefore, our target price after the bonus share issue is 31.22 yuan, which represents a 76% upside from its current price of 17.71 yuan. The company is primarily engaged in the manufacture and sale of pharmaceutical products in China. Its principal products comprise Chinese medicines, including American ginseng and Noto ginseng powder. Its revenue increased 19.5% from 13.26 billion to 15.84 billion in 2014, and its net profit increased by 21.6% to 2.28 billion yuan. In the first quarter this year, its revenue increased 19.2% year-on-year to 5 billion, and its net profit increased to 820 million in the first quarter, growth of 38%. We expect the full year revenue of the company to increase 29.8% to 20.5 billion yuan in 2015, and its net profit is expected to grow 33.5% to 3.05 billion yuan. Our target price of 62.44 yuan or 31.22 yuan after the bonus share issue is equivalent to 45 times its forward PE. I received an email from a client of Phillip Securities Singapore, Stephen. He said that he's holding China Power, stock code 2380, and which has given him quite good returns. And he wished to ask whether he should accumulate more of this counter or buy Huaneng, the stock code being 902. In terms of earnings growth, Huaneng's net profit is expected to increase 15.3% to 13.7 billion yuan in 2015. And with an estimated earning per share of 94 fund, it is currently trading at 8.2 times forward PE for 2015, and its dividend yield is about 4.9%. Whereas for China Power, its net profit this year is expected to increase 12.4% to 3.1 billion, with an estimated earning per share of 45 fund, is currently trading at around 9.7 times forward PE, and its estimated dividend yield is about 3.9%. It seems Huaneng's valuation and dividend yield are more attractive than China Power, thus I would recommend Stephen to diversify and also invest in Huaneng. If you have any question about A shares or the China stock market, please feel free to write an email to me. My email address is cs@phillip.com.hk.